We are only halfway through August, but much has already happened this month within Japanese markets, which experience far more severe volatility than other global regions during what was a broad-based sell-off earlier this month. So much so that the Topix index saw one of the sharpest single-day declines since Black Monday back in 1987. The appreciation of the yen against most other major currency pairs, including sterling, only very partially offset the falls for UK investors. The Bank of Japan raised interest rates for only the second time since 2007 at the very end of July, but this coincided with some weak economic data prints in the US, which led to a questioning of the health of the global economy. These two events combined to cause many more speculative investors to unwind carry trades in Japan, which they built up in notable size as the interest rate gap had widened over the last 2 years. Japanese indices rebounded strongly in the following days and remarkably have already made back those single-day falls, albeit still remain lower since the start of the month. This is a far too short a period of time to make any clear judgments on, but it was still an opportune point to catch up with Richard Phillips, the long-standing portfolio manager within the team at specialist Japanese asset manager Morant Wright. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this week's episode, we were joined by Richard Phillips, a director at Morant Wright Asset Management, a business he joined in 2001, having previously worked at Schroeder Investment Management, which included a period living in Japan. Morant Wright is an employee-owned asset management business founded in 1999 by Stephen Morant and Ian Wright, and which runs several segregated mandates and open-ended funds, but all of which concentrate exclusively on Japanese equities. The investment team, which includes Richard, uses a fundamental bottom-up approach to selecting stocks, with an emphasis on the quality of underlying businesses, in addition to a strict focus on valuation. We should perhaps expect volatility to continue to be heightened in the Japanese markets for the time being, given just how significant a change in trajectory of monetary policy could be following such a long and extended period of monetary easing in the country. However, the policy changes by the BOJ reflect the gradual reduction in deflationary pressure within the country and positive real wage growth, which are good signs for corporate fundamentals looking forward, in addition to potentially changing the currency outlook, with the yen looking highly depressed on many measures and having been such a headwind for traditional international investors. The Japanese carry trade, whereby investors borrowed funds in Japan given the expectations of continued structurally lower interest rates in the country to fund higher yielding investments elsewhere, had clearly built up to significant scale. This caused significant disruption in the market recently. However, analysts at JP Morgan estimate at the end of last week that a significant portion of around 70% of more speculative carry trade investors had already unwound during the recent market turmoil. Longer term, we see merit in having a two-pronged or barbell approach to investing in Japan, with both avenues, in our view, currently played best outside of the very largest businesses within the country. The first area of interest is to the smaller, innovative businesses emerging from the country. Japan's long history and commitment to innovation has led it to being home to many world-leading companies in a number of industry segments. The proportionally high spending on research and development is consistently above other major geographic regions and will likely continue to produce a high number of disruptive and valuable businesses over time. We will hopefully look to explore this theme in more detail in a future episode. However, the second investment theme surrounds the impact that corporate governance reform is continuing to have on boardroom decision-making, balance sheet efficiency, and therefore shareholder returns within the country. We explored this theme back in episode 9 of the Investor Insights series with a more specialist investment strategy run by an activist investor in the country. But the approach used by Morant Wright also plays strongly to this investment case, and we get an update on this reform and discuss the opportunity in more detail with Richard later. As always, please do get in touch if you'd like more detail or explanation on any of the topics discussed. Richard, good afternoon. Thank you so much for sparing some time today. How are you doing?
Very well indeed. Very well indeed. Well, thank you very much for inviting myself on behalf of Morant Wright to today.
No, not at all. No, good to have you on. So, Richard, we have a kind of standard opening question to these, and the idea is to kind of get a bit of an insight into perhaps something that you've been working on, whether it's a kind of research project or we've been asking for people to kind of give an anecdote from a company meeting or perhaps a kind of article that you've been reading. Is there anything you can kind of share to that regard?
Yes, certainly. I thought just to give you a little bit of an insight into a sort of a typical day at Morant Wright, we will come in and check the orders from overnight with Tokyo. We will work through the prices on the portfolio, and also we have a watch list of about 70 names, and then we will go through the portfolio and also the watch list to look at and hear about news that's come out at the moment in Japan. We're going through the first quarter results season for the fiscal year ending March 25. And then the sort of typical day will include meetings either with Japanese companies in our office near Green Park or on Zoom, or actually 3 of us this year so far have been to Japan and met companies in Japan. So, and I think in terms of anecdotes, there was a very interesting one the other day. At the start of July, we met the CFO of SMFG Bank, one of the big city banks in Japan. And in their earnings forecast for this fiscal year, they were not assuming a change in policy from Bank of Japan. But the CFO, Ito-san, did actually say to us that in his most recent conversations with Bank of Japan officials, he suggested that he told us that an increase in rates was imminent, and that was based on the back of recent wage growth. And I think that was quite interesting in terms of what subsequently happened. And I think also from our last few company meetings, we spoke to a company that's involved in road signals and the stripes on the road and barriers for traffic. And they said there that base wages had increased 6%. And that's very much the theme that we've had from quite a few of our meetings with Japanese companies more recently.
Yeah, no, thank you for that. Yeah, good to get anecdotal evidence directly from a company like that, for sure. So, Richard, when we kind of organised this recording, we were quite aware that we were going to go through a pretty roller coaster last couple of weeks for global markets, but also notably the Japanese market. So a lot of kind of volatility, and I guess a kind of confluence of lots of different macro events kind of causing that, whether it be the kind of data in the US, but also that kind of coinciding with the interest rate rise from the Bank of Japan. And I'm always kind of conscious that you are very kind of bottom up stock focused, but and appreciating this is quite a kind of changeable period, have a kind of very notable rebound from that weakness seen a week or so ago. But can I ask you for your kind of initial take on those events and kind of what you're seeing in the market at the moment?
Yes, well, it does seem historically as if every so often Japan does seem to be incredibly volatile. I remember actually at the time of when Brexit, the Brexit result was announced, I think the global equity market that fell the most, rather bizarrely, was Japan. But I think, yes, you're right. I mean, the events were very extreme recently, and it almost felt as if a fund or an institution was in trouble because the selling was indiscriminate, and it was also across the board. I think what we do know is the short position in the yen prior to the Bank of Japan announcement was the second largest on record, and brokers were speculating that this position was matched by long positions in Japanese equities and the yen carry trade generally. So clearly there was an unwinding of these positions happening. We don't know how far this has happened, but it was pretty violent. And I think some of the data I've seen in the last couple of days suggests that a very big chunk of it has occurred. I think the net result was that the market sold off very aggressively. And actually, the market was trading at 1.16 times price to book and a P of just under 12 times, according to data from Daiwa. And I think from our point of view, as you said right at the beginning, in terms of bottom-up stock pickers, I think when you've got forced sellers and it looks as if it's much more speculative money, I think that really provides an opportunity for long-term investors like ourselves to potentially add to positions where we have conviction that the fundamentals haven't changed, but the valuations have just become cheaper. And actually that really, although it's moved very quickly, we try to take advantage of this opportunity and add to some of the holdings in the fund. And actually some of the team members as well asked permission from compliance to add to their own holdings in the funds as well. So I think it really sort of highlights the difference between short-term and speculative and long-term focusing on fundamentals and the valuation.
Yeah, no, thank you for that. Yeah, interesting points there. I mean, you kind of mentioned the kind of carry trade. I wonder if you could kind of give us your kind of view on the inflation outlook in Japan. I appreciate there's lots of kind of short-term moves, but from a longer term perspective, can you kind of give us a view on kind of how you're viewing the inflation outlook and what that means for kind of monetary policy in Japan, perhaps looking a bit further out?
Yes, absolutely. I mean, as you said, I think the first thing I would say is we are very much bottom-up stock pickers. So I could well imagine you will have better people to talk to on the macro in Japan. But I think the Bank of Japan raised the overnight interest rate to 0.25 and also announced that it would be reducing the amount of JGBs that it will be purchasing each month from 6 trillion per month down to 3 trillion by April 2026. I think to some extent, these changes had been quite well anticipated. But what surprised the market, I think, was the timing. And I suppose it comes back to that original comment from SMFG, where actually when they were basing their own forecasts for the year, they were not assuming any change in monetary policies. But even so, I think in many ways, it should be seen as a positive step that interest rates in Japan have gone up to a more normal level. And I think this reflects a sort of normalization of interest rates and monetary policy in Japan, and really reflects, I think, the very positive wage environment in Japan and the quite tight labor market that we have. And if you look at the Bank of Japan's forecast for CPI, they have a number of measures, but they look at something called the core, which is all items in the CPI less fresh food and energy. And they're forecasting 1.9% for the year ending March 25, and also 1.9% for the year ending March 26, and then finally 2.1% for the year ending March 27. So I think at the moment, given the move in the currency, I think in some respects the Bank of Japan will be quite pleased with what's happened. And I think the Bank of Japan probably will wait now before it increases monetary policy, unless the yen starts to weaken from here.
Yeah, no, thank you for that. Yeah, always important to kind of put that kind of top-down kind of backdrop in place. But let's maybe move on to the portfolio itself now. Could you give us a kind of summary, if it's possible, to kind of summarize the kind of how the fund is positioned at the moment? Obviously, you kind of got a very defined kind of focus on valuation there, but are there any kind of general themes or kind of common characteristics to the types of businesses or sectors where you're currently seeing the kind of best opportunities?
Yes, absolutely. As you say, we have a very specific investment approach. Just to repeat it, we focus on companies with very strong balance sheets, number one. Number two, we want to make sure that we understand the business and the franchise clearly, make sure we're not in something that is in structural decline. And two, we want to make sure that it's attractively valued and cheap in terms of the criteria that we look at, which are price to tangible book value and also enterprise value to operating profits. We're prepared to go anywhere in the market where the value is according to those criteria. And we're rather agnostic about the sector and the market cap. But at the moment, there are definitely biases within the portfolio. In a sectoral sense, we are overweight industrials and financials. In terms of market cap, there's definitely a bias to mid-cap stocks, which we define as stocks in the market cap band between $1 to $5 billion. Currently, 54% of the portfolio is in that mid-cap range. And then there's very much a domestic bias. There are some wonderful exporting companies like Honda, for example, in Japan. But overall, 60% of our portfolio has a bias towards the domestic Japanese economy.
Yeah, great. Yeah, thank you for that. You very briefly mentioned kind of overall valuations, but could you kind of run us through some of the Japanese market is still a kind of very attractively valued market, even against its kind of own history, despite the run that we've had over the more recent period. Can you kind of give us a sense of what equity valuations look like in Japan and for the portfolio itself?
Yes, absolutely. Well, just for the market overall, the current price to book is 1.25 times. And the P, again, according to Daiwa, using Daiwa estimates, is 11.6 times, which is below the 10-year average and almost as low as it reached during the COVID period. And the dividend yield is just over 2%. For the fund, the price to book is 0.8 times. So we're standing at a 38% discount to the market. And the widest discount we've had historically has been just close to 50%. So we're standing at a pretty wide discount to the market. The current median EV to OP is 5.8 times March 25 estimates, and the P currently is standing around 10 times March 25. The dividend yield stands at 3.4%, but I think perhaps the most interesting statistic is our net cash and investments as a percentage of the market cap, which currently stands 61% of the market cap. Now, the peak for this was actually back in March 22, where it reached almost 80%. So on a percentage basis, as a percentage of the market cap, it has come down as some of the companies have re-rated. But actually, if you look at the absolute level of cash on balance sheets for our portfolio, it remains very close to record highs. And I suppose, given that, it's not surprising that actually 24 out of 64 of our companies have activists on the share register, and you can see exactly what they're interested in.
Yeah, no, absolutely. Yeah. Sometimes when you see those cash on balance sheet figures, you have to take a double take sometimes because it's just so different to lots of other places around the world. But yeah, I mean, it's interesting you mentioned activists. I mean, we would really want to talk about the kind of governance reforms that are going on in Japan, because despite kind of a lot of macro noise at the moment, that's still a really strong long-term theme, and it's something which you can clearly see the Morant Wright portfolio clearly kind of placed to benefit from. Could you kind of give us an update on the progress being made by some of those reforms, and it'll be great if you had some kind of recent examples of kind of that in action within the portfolio.
Yes, no, I think you're absolutely right. Whilst the macro is completely fascinating, actually it's at the company level, at the micro level, that it's the long-term structural change that is really playing into our particular strategy in Japan. I think the progress is really quite impressive, and there's clearly pressure that's come from the Tokyo Stock Exchange with their low price to book initiative. There's clearly pressure coming from activist investors, but it also does feel as if just in our meetings with Japanese companies, we've been doing this for well over 20 years, that actually corporate behavior is changing. And that change in terms of capital allocation it's noticeable in investor relations material, and it's noticeable with what's actually happening today. And I think, interestingly, whilst the attention has been focused on the Tokyo Stock Exchange and activists, I think it's peer pressure that's becoming very important. I think the Japanese have decided that they want to make a lot of these changes. And I think talking to some of these companies, you feel as if they're actually looking over their shoulders at other companies in their sector and seeing what they've done. And that's actually the catalyst for the changes. But the numbers are really very impressive. The dividend increase in the year to March 24 for our portfolios increased by 22%, which compares to the topics, the market, at 7%. And share buybacks for the year ending March 24 were up almost 70% against a market of 31%. And the average size was just over 4%. I think what's interesting at the moment, we're going through the first quarter results, typically a time where share buybacks are lower than other times of the years. But actually, at the moment, share buybacks are running at much higher levels than previous years. And interestingly, for our companies, 44% of our companies have announced share buybacks with an average size of 4.8. And just to repeat, it was 69% for the whole year last year. So that's just in the first quarter. And an example that happened during July, and a stock that we've owned for a long, long time, is Canon Marketing. It distributes Canon products in Japan, but as well as being a distributor, it's been shifting its business more to software. We've invested in this business for a long time. The market seems to have rather ignored this transition to greater software earnings. But actually, whilst the business is doing very well, it's always been a hugely overcapitalized balance sheet, and it's been rather frustrating in that despite engaging with the company, it's been very resistant to change. But during July, they announced a share buyback of 17% of shares outstanding. I think that just goes to show the potential and how really, for me, that the change is really happening, even amongst some of the companies that I suppose you expected a bit frustrating to deal with.
Yeah, no, absolutely. Yeah, good example there. Yeah, in our research notes on the fund, we have that chart showing the kind of returning capital increases, the dividends and the buybacks, and then that kind of very clear trend higher. And kind of any listeners can get in contact if they want to see that. Richard, I mean, the kind of increase in dividends and share buybacks, kind of one of those more obvious, kind of very clear and direct ways that kind of governance reforms is coming in. But I wondered if the other trend is on the unwinding of cross shareholdings, which perhaps is slightly less well understood. Are you able to just give us a kind of rundown of kind of why that is happening and the kind of the impact that can have as well?
Yes, I think you're absolutely right. There's a lot of focus on the share buybacks and the dividends, but actually the cross shareholdings is being unwound. And I think that corporate Japan, I think this is the government, I think this is the regulators, the Bank of Japan, the Ministry of Trade and Industry. It feels as if there is a decision by the policymakers that the cross shareholdings should be unwound. And I think perhaps certainly I was most surprised to see that with the non-life insurance companies that we've always had very large investments in, because we think they're very strong businesses domestically, they're growing overseas through some sensible acquisitions, and very strong balance sheets, solvency margins, and good shareholder return policy. But they have enormous cross shareholding. And actually the regulator has stepped in and put pressure on them. And they have announced that they are going to sell all of those cross shareholdings, which I don't think I would have ever imagined the regulator telling these three domestic Japanese insurance companies that they would do that, and also that they would sell all of them. So I think that really is a very dramatic change, but equally with a wonderful company operationally like Toyota, which whenever you meet Toyota or any of the Toyota group companies, I think I always come away from meetings thinking, gosh, I wouldn't want to compete operationally with these businesses. They're just incredibly tough. But in Toyota's case, it has been very frustrating because the corporate governance until more recently has been quite poor. And they have an incredibly strong fortress-like balance sheet. But they've been very reluctant, it seems, to unwind their cross shareholding But even there, that is changing, and they've sold off large amounts of KDDI, and actually they are starting to reduce substantially positions in other cross shareholdings now. And I think that's very important as a sign, because Toyota is very much top of the corporate pyramid in Japan. So I think everything is up for play and up for grabs. And as you say, I think just to go back to first principles for our portfolio, actually on the one hand, the question is how much of that net cash as a percentage of the market will actually cap, which is currently 61%, how much will that be returned to shareholders? Will we be looking in 5 years' time that has gone to zero? The other side of the equation is to what extent can these companies increase the underlying profitability of their business, which is not about the net cash on the balance sheet, but increasing the operating profits and improving the return on equity. And there as well, you feel as if Japanese companies are being run on a more profitable basis and more in the interest of shareholders. So there are these two giant levers in play, and it's very exciting at the moment.
Yeah, no, absolutely. Yeah. Richard, our kind of standard final question is one that kind of asks the speaker if there's one particular area or even one stock within their kind of investment universe that they maybe highlighted the opportunity kind of well, or was particularly high conviction at the moment. Could I ask you for if there was one area that you kind of highlight there?
Yes, of course. I must say I found this question much harder than usual, because I think on the current valuations for the overall portfolio, and I said with some of us putting our own money into the portfolio given the recent pullback, I think the whole portfolio looks pretty compelling at the moment. But I think obviously in terms of conviction, it would be sensible to look at holdings in the top 10. And at the moment, I mean, just to run through the case for SMFG, I suppose in many respects, a big city bank, rather like HSBC or Barclays in this country. I think it's the direction of net interest income with, after so many years of operating in such a harsh environment, the domestic spreads are improving, and there's also some loan growth as well. Their overseas spreads business are improving as the loan book is rebalanced away for some lower margin project finance business and some higher margin overseas business. The domestic asset and wealth management business seems extremely well positioned for the growth in NISAs. Cost control in our last meeting is very impressive and reassuring. And the capital ratio stands at just under 10%, which is very solid and gives them scope for more share buybacks in addition to increasing the dividend. And at the moment, in terms of valuation, that's on a price to book of 0.8 times. The dividend has a dividend yield of 3.7, and on a PE into the year ending March 25 of 11 times. And I just think that actually, interestingly, if you look at the book value per share over the last 10 years, and remember what a hostile environment this has been for banks in Japan, SMFG have managed to increase their book value per share every year over the last 10 years. And I think in some respects that's quite a surprise, but I think that's a pretty interesting example of the sort of opportunities and inefficiencies that exist in this sort of market for stock pickers like ourselves.
Yeah, absolutely. And a good example there. Richard, really good to talk to you, particularly at such an interesting time in the market. But yeah, really appreciate your time. Thank you.
Absolute pleasure. Anytime. Thank you very much for the opportunity.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.